firm Motive Partners. Well, joining me now is Charlie Kerr. He is the founder and CEO of With Intelligence. Charlie, welcome to you. Now, Intermediate Capital have committed to further investment in the group, along with Motive. What sort of sums are we talking about?
The deal that we've announced today is an enterprise value of over 400 million. And ICG are going to be a significant shareholder going forward, as well as management too. So we're really excited about continuing the journey with them and bringing Motive on board.
But there will be new money coming into the business.
Yes.
And what will you be using that for?
So I think it's a really exciting time for asset management. And as a business, what we do is we help asset managers raise assets from institutional investors, and we help institutional investors deploy assets better. Lots of exciting stuff happening with AI. Lots of stuff happening with analytics. So the reason we've chosen Motive as a partner is they really specialise in financial tech. And what that will do is mean that not only do we get the sort of investment, but we're also going to get the use of their operating partners, and we're also going to get access to their innovation talent. So it's really about bringing the capital in, but also bringing the talent in that's going to help us drive forward.
What's demanding growth in demand? What's driving growth demand right now?
So I think it's a fascinating time for asset management. I think you covered on your show last week the Mansion House Compact, which is really going to see a lot more money going into alternatives. The UK is a big hub for alternatives, and so I think alternative managers are becoming more and more sophisticated and bringing a lot of their fundraising in-house. And so services like ours really help them raise assets.
I mean, anecdotally, it sounds as though sentiment in the hedge fund sector, there's a bit of anxiety hanging over it right now, and private equity is certainly going through quite a sort of lean phase, if we can put it that way. To what extent do your fortunes rise and fall with those of the industries that you're supporting?
I think providing stuff is happening in the industries that you're supporting, you are going to be an important resource for them. So the hedge fund sector has been fairly flat for some time. We've grown on an annual basis over 20% within our hedge fund space. And that's because of the amount of data and the amount of analytics that you can provide to these people now is more and more. And these businesses really rely on services like ours in not only raising capital, but also comparing themselves to their competitors.
Do you worry about competition from the likes of Bloomberg and Refinitiv?
No, I think we really complement the likes of Bloomberg, and I think what we can do is go deeper into a sector, and we can do that with a sort of proprietary data set that we build by our relationships in the industry. It is that we fill a very important role within the critical use case of raising assets, which other people don't focus on as much as we do.
All right, Charlie, we've got to leave it there. Good to see you this morning.
Good to see you. Thanks a lot.
We're now going to go back to our top story, that report out in the last hour from the Competition and Markets Authority, which says that high food price inflation has not been driven by weak competition. Well, joining me now is Sarah Cardell. She's the Chief Executive of the CMA. Sarah, welcome to you. You're going to disappoint an awful lot of people who've been pushing this greedflation story. You don't think there's any evidence of it in grocery retail?
So what we've been looking at really is to understand how well competition is working in the groceries market. It's obviously incredibly important at the moment. We all know that households are feeling the pressure of high food and grocery prices. We want to make sure that competition in this market is working as effectively as possible. We also want to make sure that people can shop around and compare prices and get the best deals possible. So it's a complicated market. There are a number of different product categories. And of course, it's not just about competition at the retail level. It's about competition up the supply chain too. What we focused on in this phase is understanding how well competition is working between retailers. And what we've seen is that there's no evidence that weak competition between retailers is driving those high food and grocery prices that we're all experiencing at the moment. We've seen evidence of low and falling margins on groceries. We've seen evidence of retailers competing for market share, competing on prices, seeking to win share. Really important, I think, in this market is to highlight the role of the discounters, Aldi and Lidl, who compete very aggressively on price. They're winning market share from the major supermarkets, and we see people turning to them increasingly to get a good deal.
What's interesting, though, is that you're now widening the investigations to look at the broader supply chain. I mean, the implication there is that some of these big food and drink suppliers, the likes of Nestle, for example, may well be benefiting from higher prices.
So as I say, it's important that we understand that competition is working well across the market. Now, it would obviously be an enormous exercise to investigate every single aspect of this market. What we want to do in the next phase of our work is to drill down into a selection of particular product categories, looking at retail competition at that level. And it's important, of course, to emphasise that the discounters, Aldi and Lidl, are not present across the full range of product categories that we know the major supermarkets are. So we want to explore retail competition on some of these individual product categories, but also look across the chain, make sure that competition is working well when we come to the product manufacturers and the input providers as well.
Now, another thing you've been quite clear on today is that you want more consistency over unit pricing. What sort of enforcement powers do you have here?
Yeah, so this is really important. If you think about unit prices, this should be a really important way for shoppers to be able to compare product prices really easily, particularly when we're thinking about products that come in different sizes. You can buy sort of multi-packs and that sort of thing. So there are rules on unit prices. Retailers are required to provide clear unit prices. Unfortunately, our investigation so far has shown that those rules are not as clear as they could be. So we're making recommendations today to government urgently to bring forward improvements to those rules. But we've also seen evidence that the retailers are not complying with those rules. So at the same time as asking government to improve the rules, we're calling on retailers now to step up their game in this space to make sure that they are complying fully with the rules on unit pricing. This is really important, particularly in relation to promotional pricing, because obviously at the moment people are desperately trying to get the best deal possible. We want to make sure that shoppers can get really good and clear access to information about how to compare prices.
Now, one thing also that you say in the report which caught my eye, you said there are some signs grocery retailers are planning to start rebuilding their margins. What sort of evidence do you have for that?
So we understand directly from the retailers that their intention is to seek to rebuild margins. Now, of course, that's off low levels at the moment, but it is an area which we want to keep a very close eye on, because it's going to be absolutely critical that that competitive pressure remains. And particularly as we look forward over the next few months, we expect to see those input prices starting to fall. We want to make sure that that competitive pressure is driving through the benefit of those cost reductions and that we see that coming through in the prices for shoppers.
Now, while we have you, it's obviously a very busy time for you. You initially moved to block Microsoft's taken of Activision Blizzard. It now looks as though you've compromised with the parties involved here. Some people are accusing you of having caved into pressure from Microsoft. What do you say to them?
I say we certainly haven't compromised. Our decision to prohibit the deal stands. We understand from Microsoft that they would like to put forward proposals to us to restructure the deal, potentially re-notifying that deal to address our competition concerns. If they do that, we will consider those restructured proposals carefully. But anything that they put forward to us will need to fully and comprehensively resolve our concerns. Our position on that hasn't changed.
And what's the timescale here, Sarah? When do you expect Microsoft to come up with some sort of revision to their proposals?
So we're waiting for those proposals to come to us. We've agreed with Microsoft a stay on the litigation, which means that we can focus on understanding whether it is possible for them to provide a restructure that addresses our concerns. The ball is very much in their court at the moment.
All right, Sarah, we have to leave it there. Appreciate you joining me today. Thank you.
Thank you.
Some other business news stories for you now. The UK's biggest supplier of kitchens to the building trade insisted today its builder customers remain busy despite the continued challenging macroeconomic backdrop. Howden Joinery was reporting a pre-tax profit of £111.9 million for the 24 weeks to the 10th of June. That was down nearly 23% on the same period last year, which the company, which operates from more than 800 depots across the UK and Europe, said had been an exceptionally busy period as the sector grappled with big order backlogs after the lockdowns. The defence contractor Babcock has suffered a major drop in profits after taking a £100 million hit on a contract to build frigates for the Royal Navy. The company admitted in April that it was in a dispute resolution process with the Ministry of Defence over increased costs related to the Type 31 frigate programme. It meant that Babcock, which employs 28,000 people across the world, including thousands at HM Naval Base Devonport and HM Naval Base Clyde, reported an operating profit of £45.5 million for the year. To the end of March, that was down from £226.8 million in the same period a year earlier. Babcock said underlying operating profits were up 6.3%, excluding the Type 31 loss. The parent company of Royal Mail named one of its senior managers as its new chief executive today. International Distribution Service said Martin Seidenberg would take the role after a revision of its corporate structure. The company previously had no group chief executive, but instead had two individual CEOs for its operating divisions, Royal Mail and its international parcels delivery arm, GLS. Well, Mr. Seidenberg was previously chief executive of GLS. IDS also reported group sales of £3 billion for the 3 months to the end of June. That was unchanged on the same period last year. Within that, Royal Mail sales were down by 4%. EasyJet provided more evidence this morning of the bounce back in air travel as it reported record results for the third quarter of its financial year. The carrier made a pre-tax profit of £203 million for the 3 months to the end of June. That compared with a loss of £114 million for the same period a year ago. It carried 23,454 passengers during the period on 146,816 flights, with 9 in 10 seats occupied on every flight. It said it expects results for the current quarter, which ends in September, would also be a record. Shares of IG Group rose by more than 3% this morning after the financial trading and spread betting platform reported a fourth consecutive year of record sales. Well, these rose by 5% to just over £1 billion for the first time for the year to the end of May, partly reflecting an increase in interest income in the United States. The company said trading revenues had also held up despite a drop in customer numbers, which swelled during the pandemic in both the United States and the UK. And England's biggest winemaker today predicted another strong harvest following the record it achieved last year. Chapeldown said growing conditions in 2023 had so far been positive and that its vines were developing ahead of seasonal averages. Well, the news came as the company reported sales of £8.37 million for the 6 months to the end of June. That was up 21% on the same period a year ago. Sales in the off-trade were up by 25% and sales in the on-trade up by were 20%. Sales in the on-trade up by 25%. Andrew Carter, the chief executive, said sales had risen due to stronger demand, greater distribution and more customers trading up to premium products. Well, the pound sold off sharply yesterday on the soft inflation data and it's continued to drift this morning. Here's the current picture. Sterling off another 0.25% nearly against the US dollar. It's off by more than 1/3 of 1% against the euro. The single currency, meanwhile, up 1/8 of 1% against the dollar. On the equity market, stocks in the Asia-Pacific region had a largely downbeat session. Only Sydney and Mumbai avoided declines in the region. That's more about concerns for Chinese growth there. In Europe, it's the situation. Stocks trading largely to the upside today. Talking points, though, include the Dutch chip component supplier ASML, one of the biggest companies in the Netherlands. It's off 3.5% in Amsterdam after downbeat comments overnight from the Taiwanese chips giant TSMC. Well, here in London, the FTSE 100 is up again, basking yesterday after those benign inflation figures. The FTSE 2/3 of 1% higher on the session right now. The house builders and commercial property stocks are again in demand, although in percentage terms, the leading blue chip gainer is Anglo-American. Shares there up some 5%. That's following a production update this morning. Outside the FTSE, mentioned them a moment ago, Babcock, the leading gainer. Its results have come in better than feared. Look at that. The share's up 12% right now. Another interesting gainer today, the air conditioning specialist Volution. You'll recall we've had the chief executive of that company on the programme in the recent past. Its shares up 6.5% on news that results this year are going to be better than expected. On the downside, the data and analytics specialist Essential is off by 4.75%. That's on reports that 3 bidders for its consumer data arm have walked away from the auction. Meanwhile, the oil price sold off last night after briefly trading above $80 a barrel. It's clawed back some of those losses this morning. A barrel of Brent crude will currently set you back $79.65 a barrel. That's up 0.25%. Well, joining me now is Janet Murray. She's head of market analysis at RBC Brewin Dolphin. Janet, good to see you this morning. I mean, the UK inflation number really did give the FTSE and the FTSE 250 a real fillip yesterday, and that's continued today.
Yes, absolutely. Thank you for having me. I think markets have been quite pessimistic on UK assets because of the high inflation number. And I think yesterday was great because finally we have an inflation print that is below estimates. So I think it is heading into the right direction, right? Headline, core, and services inflation all slowing down. So great news for the markets, which have been pricing in very aggressive rate increases. So I think markets now think there's no need for further panic rate increases in the UK, which is beneficial for UK assets.
Are you surprised to see the extent to which the house building stocks in particular have rallied? I mean, they were up 8 or 9% at the open yesterday.
Yeah, I think it's a very strong rally, but we also have seen a substantial slump in those house builders' share prices because of these very high rate expectation. And I mean, the housing market in the UK is already slowing. We saw house prices are slowing. So if the market expectation of 6.5 interest rate were to be realized, of course, those would be a big hit. But now, because of this slow inflation figure, markets are now pricing in just below 6% of peak UK interest rate. That's a substantial improvement from where the market were pricing in. So I think there is a case for a rally for these house builders. Now,
we had results overnight from two of the most watched stocks in the United States, Tesla and Netflix. What caught your eye in those?
Yeah, so both shares were down in aftermarket trading and pre-trading. I think markets were a bit disappointed, despite actually the results were okay. Well, first of all, we have to understand these stocks have rallied very strongly year to date, so a lot of a high expectation baked in. So for Netflix, actually they managed to gain a lot of subscribers because of the change in the password sharing policy. So there has been a crackdown on password sharing, and also they are introducing several tiers for customers to choose based on the advertising showtime. But the revenue side disappointed. So obviously, the revenue per customer is not as good as people anticipated. So there's a hit to the share price. And for Tesla, I mean, we know that Tesla has been cutting prices to their cars because they want to boost production because there has been so much competition and consumers are also squeezed. So that is great for the production numbers. But again, that is a squeeze on profitability when they cut prices, isn't it? So I think investors were just a bit disappointed.
Yeah, and it was also notable, Elon Musk last night was flagging a big increase in R&D costs as well. So, I mean, again, that gnaws into returns for shareholders in the short term.
Yes, exactly. I mean, these are quarterly earnings data. I mean, investors, sometimes they can be short of patience. So, of course, investment is actually good for the long term, but it involves, I think, a 1 billion investment into that. And Tesla is also running down their inventory. So I think this is all short-term squeeze in their profit margins, which investors are not very happy about.
All right, Janet, got to leave it there. Always good to talk to you. Thanks for joining me today.
Thank you.
Still to come here on Business Live. Turn to freelancers by UK businesses. How fewer full-time staff now make up the workforce. Stay with us.
So essentially what we're seeing is that measles rates are increasing across the UK. Most of those cases are in London, and that's on the background of the lowest rates of MMR uptake that we've seen in over a decade. So we know that measles is an extremely serious infection. It can lead to serious complications and even death. And that's why we're urging people to go forth, get their vaccine if they've missed 1 or 2 doses. So there's many reasons why it's an issue. We have been seeing since COVID rates of routine childhood vaccinations decreasing across the whole world. And we also know in London that rates are generally particularly low and lower than the rest of the country. And again, there are many reasons for that, including the London being a mobile area, people coming in and out, missing vaccinations. And we also know that there are pockets of communities with very low uptake. And all of that means that we've got people within the community that are vulnerable and at risk. And that's why we need them to have the vaccine to protect them and to make sure that nobody is left behind. So we do know that that's 19 to 25-year-old age group have got lower vaccine rates. And that's due to those scare stories from the 2000s, which have been seen to be completely unfounded, with many studies now that have disproven that link between autism and the MMR vaccine. We know that the vaccine is highly effective and safe. It saves many lives all the time, and most of all, it can protect from those serious complications of measles and the long-term complications. Measles can cause pneumonia, it can cause ear infections, it can cause diarrhea, but it can also cause encephalitis, that's inflammation of the brain, and it can cause death. We know that 20 to 40% of those infected will be hospitalised, so it really is something that we need to protect against, and we have a vaccine.
Slightly minutes, slight better. Fly Emirates, fly better.
Thank you.
Welcome back. Our research published this morning suggests that 8 out of 10 UK businesses are planning to hire more employees during the next 6 months. However, amid widespread skill shortages, more than half of those businesses admit it's going to be a challenge to fill roles. Well, the research was carried out by Fiverr, the $1.1 billion US-listed but Israel-based freelance marketplace. And joining me now is Micah Kaufman, the chief founder and chief executive of Fiverr. Micah, good to see you this morning. Which are the skills that businesses are most in need of?
Good morning, and thanks for having me. So essentially what we've seen through the research is that there's an aging workforce and a significant digital skill gap amongst the current workforce, meaning that businesses are turning to freelancers who are more rapidly possessing those digital transformation and technological skills that they require. That could be anything from data science to AI-related skills, or anything that has to do with online digital transformation.
And this is partly because, according to your studies, some of these people have been let go too rapidly in the recent past. I mean, we know there have been some heavy layoffs in the tech sector over the last 18 months.
That is correct, and that is being reflected in the amount of people that are turning into freelancing and are joining our marketplace to offer their services.
And you think this is how companies are going to fill these skills gaps in many cases? They're going to reach for freelancers?
Well, it seems that this is the case. As you said, 8 in 10 businesses plan to start hiring again in the next 6 months, but 60% of them feel that they cannot fill those roles. And that is why they're turning to freelancers. And I think the most common reasons to engaging with freelancers, as we learned from the study, is one is to supply missing skills in permanent workforce. The second is to support staff overload, which is a pretty big issue, increasing productivity and avoiding making permanent hiring because of the unstable market.
What motivates someone to become a freelancer? Is it because they want to perhaps have more jurisdiction over the hours that they work?
Yeah, so from the research, we've learned that people turn to freelancing mostly because they feel that they want to become their own bosses and have better work-life balance. That provides them with more flexibility to try different skills and experiment to figure out what are they good at. And I think that their ability to gain new skills more rapidly, turns them into a more competitive offering for businesses.
The evidence is, though, that they earn less than salaried employees. Is that largely because they do work fewer hours?
Well, in some cases, this is the case. In some cases, it is because they're engaging both in a combination of a 9-to-5 job and then they're supplementing through freelancing, which becomes just a part-time solution. Sometimes it's because there is less need for these very specific skills. Well, we've seen on our marketplace is exactly the opposite, which means freelancers are making more and more money over time as the demand for freelancing increases. And it's like in any job, it's about optimizing your offering and making sure that you're offering something that has high demand.
All right, Micah, we have to leave it there, I'm afraid. Very good to talk to you this morning. Do appreciate you joining me. Thank you.
Thanks so much for having me.
That's it from me for the time being. I'll be back, of course, at 4:30 with our afternoon edition of Business Live. Hope very much to see you then. In the meantime, do stay tuned. Coming up after this short break, it's Anna Jones with all the latest on the ongoing disputes between Coutts and Nigel Farage. See you later on this afternoon. Cheerio.